However, I'll say this: the thing about it is, it's kind of an artificial sort of recession, if you could even call it a recession, because the bottom line is wages have actually been going up pretty steadily for the first time in a long time, which has its positives. The other thing about it is job growth has been pretty steady. It's cooled off a little bit, but it's still been going pretty well. Um, and the economy's been actually doing pretty well for the most part, right? Not to say there aren't still problems, but it's been a lot better. So companies are making good profits. So you'd think the market would be going up, right? Sort of in a normal situation, it would be. But in this situation, what's happened is the Federal Reserve, because inflation has been really high, the Federal Reserve has raised rates. So just so you understand, the Federal Reserve has basically two goals. But it's basically the bank for the federal government. Okay, so it holds the money. Now it has two goals. One is it wants to keep unemployment as low as possible, or employment as high as possible, right? They want to maximize employment, and they want to keep inflation moderate, right? So they want to keep between that 2.5 to 3.5% kind of goal all the time. Inflation got up to 11 at one point. I think it's still at like 6 or 7 now. But to keep inflation down and help with that, they basically have what's called monetary policy. So they got three things they can do. They can either raise interest rates on banks, which means if I raise the interest rate by whatever it was, 0.5 percentage point, that means the rate that you can loan money from the Federal Reserve or the key banks, there's like 10 key banks that do that, big banks, they have to raise their rates by that, which means the rates as they go down are going to go up and up and up. So it raises rates all across the board for everything from car loans, home loans, everything, right? To all of us. So it makes it harder to get money for businesses. So it squeezes the money. If they lower interest rates, it means money is more available because you can get cheaper loans, right? And businesses, that's how businesses do a lot of their day-to-day business is they loan the money and then they repay it. So when you raise those rates, it squeezes down the amount of business, the amount of outflow, which can squeeze down inflation. Now, the other things they could do is they can buy back bonds and things like that, or sell bonds to lessen the amount of money in the economy. And I mean, those are a couple of the main things. They could also change the reserve requirements, how much money a bank has to have to back each loan. So, like if I loan Lacey $1,000, the Federal Reserve says you got to have 10% of that. So I have to have 10% to back the loan, right? So that's just how that goes. But I can loan out more money than I physically have. So that's kind of what's going on. So the Fed has been squeezing, right, what they call contractionary policy, trying to squeeze the amount of money in the system by raising interest rates. And that panics businesses because it means it's harder to get intraday loans to do business. So what they tend to do is sell off a lot of their stock to protect their cash preserves. And that's sort of what's going on here. I mean, there are a lot of other factors here, but that's a lot of what's happening. So it's one of those things where you think, oh, it's good news, the market should be up. Well, yeah, but it's good news with inflation, which means you're going to see more contractionary monetary policy, which spooks out corporations, which own a lot of the stock. So that's kind of what happened in the market. If you guys just the nuts and bolts of it, right? If you guys wanted to know. But yeah, that's sort of what's going on. The other thing that's funny about it too is a big portion of the inflation problem. I mean, a lot of it's been coming out of COVID and the supply chain slowed down and all that stuff. But one of the big things that stopped it is, or really knocked it up, was corporations realized, hey, inflation's going up, so we can artificially inflate our prices and make more money. So a lot of what that is on top of that is these companies started to just jack up prices so they can make more money, even though it wasn't really necessary to do so. But because they knew the demand was there, because everybody was getting out of COVID and shopping again. So they kind of created the problem that they're in and the market's in.
Right.
Yep.
So essentially, to boil this down to what the average person is seeing because of what's happening in the monetary policy, what are the things that the average just like consumer should be noticing as a result?
Well, one, I mean, as a consumer, you've noticed prices have gone up on a lot of goods. You've also noticed if you have retirement accounts and stuff, those have not done well. Those have actually probably lost money this year, right? And part of that is because there was a big inflationary push, but B, the companies, a lot of these corporations realized, hey, we can inflate the price even more and make more money. And so they did that. And the problem is once you do that, it's harder to walk back prices. Most companies don't want to lower prices because they have to do their reports to their shareholders. And so if they lower prices and they see a reduction in growth or anything, then it looks bad, right? And people tend to sell. So you're kind of stuck in this position where they inflated the prices to jack up their profits because they saw a temporary opening. But now they're in a bad position because, well, our stocks are tanking because we have to sell more and more in order to protect our cash position, right? And then what ends up happening is you see that happen, and you get sort of what's called herd instinct in the market, which is the average people see the market's going down, so they panic and they sell, and it kind of piles on itself. Even though, despite all this is happening, the economy is doing pretty well, which is but that's what's causing it. Is the economy is doing well. These guys have artificially raised inflation, so it's forced the Fed to try and raise interest rates to try and squeeze down the inflation. So it all kind of feeds into itself into a loop on how these things happen. I mean, you never know what's going to happen with the markets and stuff, but this is kind of what happened here in a nutshell. So it's one of those things where I think the smart thing right now is don't worry about your accounts. It'll come back. I mean, it's not worth it because if you sell now, you're selling low and then you'd be buying back higher. So it's better just to sit on it. The only other thing to do is you just got to manage with the inflation as it is. I mean, there's not a ton you can do. But yeah, so that was that.